We're a fintech company at Flip. We're a financial services fintech company that operates as a SaaS mechanism. We have about 30,000 people subscribed to our platform right now. That's a decent number. And we are just now coming out of our beta launch. The software is currently managing about $33 to $35 million, depending on the day. The stock market goes up and down. And we've spent about $4 million over the last 3.5 years building this software to do what it does. Now, there has to be some reasons why you do that. And so this is where I'm going to give you guys some business coaching as we go along here. So there is a process of growth through your company. You got to prove the concept. Do people really want automated trading? Do people want trading done by AI versus a human? Those types of conversations. However, today, what we're going to really talk about is the financial services space. The financial services space is quite unique, and we're going to spend a chunk of time talking about that. I'm going to recap on algorithms and AI and give you a little more depth into algorithm or AI. Remember, all algorithms are not AI, but all AI is an algorithm. We're going to talk about the flaws in the landscape. Going to give you some examples of the AI at work, and I'm going to talk to you in this whole process about, I briefly highlighted the best and worst 10 days, but we're going to dig into, I'm going to actually show you what a mutual fund costs. If you happen to be a financial advisor, this is not negative towards financial advisors or planners at all. They serve a very important role, but I would encourage them to listen to what we're talking about and look at us as possibly a B2B option as a better way to manage their clients' money. Because if they're the fiduciary, if you're a fiduciary in charge of money of somebody else, and you know that there's a better way to manage the money that costs the client less, and exposes them to less risk, that's what you would, you might feel a little obligation to do some of this. No pressure. So again, about me, I introduced myself yesterday. I'm not going to give you guys the whole spiel again today, but I'm a self-made entrepreneur. I am formally educated in education. I have a master's degree in education. I was a former high school science teacher and football wrestling coach. I often joke, and I just did an article that's going to be in every United Airlines airplane in North America. And one of the things I say in there is that everything I need to know about running a company at any scale, I learned coaching high school freshman football. If you can get a group of high school freshman football players to act in unison and work together, you can do that anywhere. And the principles are truly the same. And I took that into my first company, which I grew in 4 years and sold to a $1 billion publicly traded company, very good exit for me. Started my second company, education and training, executives and small businesses all over the world. I sold that company and actually then joined a company called Infusionsoft. Spent 4 years with those guys as a senior level executive, helping them grow as a consultant first, then as an executive vice president. And then now I'm at Flip. And so there's a theme about what I've done is I always hunt problems that need a solution and then go solve it in a way nobody else is doing it. And that's how you can get yourself an exit. So just 5-minute overview there on that. So let's get into the table of contents, what I talked about, financial services. Okay. We live in a world right now that is, drastically improved from the predictive intelligence and automation that's out there. If you don't believe me, go look at something on your phone. Go to Google and search something. And then tomorrow, watch what kind of ads pop up. Holy moly, I was just looking at that. How do they know I want that? How does Google always know that I want that or I'm looking at that? Well, that's AI. That is AI and algorithms working. Google has some very powerful AI. I work with one company, how we market ourselves. There's a company out there, you probably don't even know this. They will go to Google to verify LinkedIn information on certain fields, and they can scrape. You could say, I only want director and vice president level executives at software companies in the Silicon Valley. It will go get you all their name, email, and phone number, so you can email them and market to them. It's that easy. It's available to the public. You can do it on a global. I want everybody that works at company X. I want all Apple's executives or managers. You can get that. How do you think they find all that stuff? It's all AI. The world in general has been altered because of it, with one real exception: financial services. Financial services is skewed. It's not fair. Everybody does not get treated the same in the financial services space. The guy with 100 grand and the guy with $1 million do not get treated the same as the guy with 100 million. They just do not. It doesn't happen that way. But the system's not broke. It was actually built this way. And what it is, it comes from an elitist mentality, in my opinion. They believe that you're not able to manage it. You can't do it. So let us do it. A lot like our government. We'll take care of it for you. We'll do it for you. And for that, we're going to charge you a fee. So right now in financial services, you really have three options. You buy it and hold it with a traditional, financial planner, whether it's a private one, that's a small boutique shop, whether it's Edward Jones or Fidelity or Schwab. They all do it the same. They want you to stay the course, buy and hold, and that is what they want you to do. And I'm going to teach you really why and show you what that costs in a couple more slides. Or maybe you were born with some money. Maybe you've got enough money where you can move even outside of a Wells Fargo or a Chase Bank money manager that they'll put any small amount into someone that'll manage 100 grand, 200 grand, 500 grand. Maybe you're even accredited and you can participate in a hedge fund, or that wouldn't be an accurate assessment. If you're able to do that, you're going to be participating a little differently. But you're still going to be paying somewhere between 1% and 6%. It's extremely expensive, and you're going to learn about transparency today. You're going to learn a lot about transparency. And their returns are mediocre, not because the returns are mediocre, because the returns have to overcome the fees. The returns have to overcome the fees. Or we try to do it ourselves. And, there's a lot of, there's Wealth Lab, there's Thinkorswim, there's all kinds of programs out there that help you do that. Heck, now there's real estate stuff, even beyond Zillow. How do I buy this real estate? How do I buy that real estate? But there's lots of education around what you should be doing. And a lot of that education is not coming from people that are doing it. A lot of that education is not coming from people that are doing it. Would you want to learn how to flip real estate from somebody who has not successfully flipped 100 houses? I wouldn't. Would you want to learn, basketball from somebody that's never played before or played in their backyard? No. But we have a lot of people in all the spaces, in Forex, in futures, in options, in crypto, out there teaching you how to do it, and they've never actually done it themselves. Spoken like a true teacher, I know. Learning how to do it and actually doing it are two different things. So when you look at this and you look at this potential for predictive intelligence and automation in the financial services industry, what would be our target audience? Who has the most to gain out of this? Who can actually learn how and grow their wealth better with this technology? Well, if in a world that becomes drastically improved through this predictive intelligence and automation, it is the average Joe. And all of us on this call are the average Joe. Unless there's somebody on here that's got, a third comma in their bank account, that means past $1 million into $1 billion, then you're the average Joe. Because the people with, under $100 million don't get the same treatment until now. And so that's the idea. I want you guys to truly leave here today with an understanding that the financial services market is skewed. It's unfair, and it is not set up for you to really win. It's set up for you to stay alive and slowly grow, and in 30 years, you'll have money. So that's what we're going to talk about. I'm going to give you some really key examples. Example number one, and I mentioned this a little bit yesterday. I talked to the high level of this, but this is an example of how the average Joe gets beat up. And there's a lot to this, and I'm going to unpack it. So the solution today is to write it out. Right? Institution state that you miss those days, it's too expensive. You got to write it out. The markets will always come back. One of those two statements is true. The market is designed to continually go up. By design, it is designed to do that, and they are accurate to give you that information. However, as my good friend, Mr. Paul Harvey used to say, now for the rest of the story. So to help investors manage the volatility, the conventional wisdom investment firms is to recommend a traditional asset allocation. Spread it out, a lot of different things. That's your allocation of the assets. The thinking goes that a buy and hold approach will, let me say this one more time, a buy and hold approach will help investors accomplish long-term goals. But for it to work, they must stay invested all the time, including during severe market declines. I'm sure some of you wrote out 06, 7, and 8. You either held real estate or you held portfolios and you wrote it out. And it was painful. And you saw it go down every day, and you're losing money and you're paying fees. And it just is painful. But that is the traditional model. That's the model, and that's what they teach you to do. So let's unpack that a little more. What does that look like? So over the last 20 years, the S&P 500 has been down 50% or more twice. Simple math, anybody can do this, tells us that when your portfolio is down 50%, you need a 100% return to break even. Assuming that you're going to get the actual 6% return, that means on a 50% decline, it'll take you 12 years to recover. So why on earth would we ride that out? This is true for all asset classes. This is true for crypto. This is true for real estate. We don't think about real estate. 07, 08, what happened to your real estate? Oh, yeah, it didn't do so well either. Lost a lot of money in real estate during that time. We all did. But so here, I got my chart over here, and I'm looking this way because my screen's over here. If you look at it, a 10% loss, it's going to take you a year to recover that. Now, let me back up one more time. 10% loss means you must actually get a 50% loss means you must get 100% return. So what, Randy, that doesn't make sense. If I lost 50%, then I gained 50%, I should be at even. No, think of it like this. If you have 10 and you lose 50%, you've lost 5. Now you've got 5 left. You must get 100% of 5 to get back to 10. That's how it works. So now, when you look at this and look at these downturns, and where's the market at now? The market's down 20% right now. So if you're in it still, it's down 20. Real estate turned. Real estate's on the downside. All the reports. You're looking at 3 years if it doesn't get any worse. If it doesn't get any worse, if it gets worse, you're adding decades to the time to recover. So why would we do this? What's the answer? Okay, Randy, what do I do differently? Well, it's simple. You risk less. You just risk less. Okay, great. Love that. If you went and played, we talked a little bit about Vegas yesterday. If you went and played the roulette wheel, what is there? 50 numbers on there. I don't play roulette, but I know there's a whole bunch of numbers on there, and the double zero and the zero for you to bet on. And they pay like 35 to 1 odds. Would it be better? Would it be less risky if they took half the numbers off? Well, yeah, your odds would go up. What if you only play the 2 little ends where there's one of the 3 little columns or black and red? Now you're at 50-50. It's a 50% risk. You're risking $1 to make $1. Believe it or not, roulette, risking $1 to make $1 on black or red is less risky than investing in mutual funds. I'm going to show you how that works here in a minute. Now, over time, I'm not telling you guys to go to Vegas. It's not what I'm saying. So let's talk about risking less. Buy and hold. Here's an actual research study. $1 million invested in the S&P 500 in 1998 would have grown to 5,045,000 by 2020. Most people say, wow, that's really good. I'd give $1 million to have 5 million 20 years later. That sounds fair. I like it. But that's just if you bought and held. What happens if we try to risk less and we try to time the market? We've been told we can't time it. Also a myth. What happens if we can't time the market? Well, we miss the big days. If we miss just the 10 best days in the market, it's the only days we miss. We hit every other day, we're in every other time, and we just miss those 10 days. That $1 million would now only be worth 2.5. So it would cost you $2.5 million to try and time the market, to try and guess, to try and, I think it's made its high, I'm going to take it out. I'm going to be smarter than the market. Okay, great. The rest of the story. If you also miss, along with the 10 best days, you miss the 10 worst days. Okay, you miss the 10 worst days as well. So you're only playing in the middle. You don't get the high, you don't get the low. You predate the middle of the market. That $1 million would now be worth $10.7 million. So is it worth risking the 10 best days if you also miss the 10 worst? That's the idea. This is what hedge fund managers do. This is what big money does. This is what the guys at Goldman Sachs will do if you have enough money to hire them to privately manage your money. It's a different world. That's how it works. Knowing all along that there's going to be a lot of people out there trying to do it themselves that are going to be creating spreads in the market that they're taking advantage of. So your objective and the best answer is today to buy and hold. Just leave it, just write it out. You got 20 years. You can invest in things like annuities. Annuities are great if you don't ever want the money for 20 years. They're fantastic because they've got a floor. They act very similar to this. If you're going to keep the money for 20 years, an annuity is much better than the traditional stock market. You want to make sure that you're not just putting your money in and holding it, running these risks, especially right now, because the market's still, even at its recent drops, very, very high and overbought. So what does that look like on a chart? Pretty simple. Which one would you prefer? If we started with the exact same amount of money, which one would you prefer? This works for real estate, works for cryptocurrency, works in the bond markets, works in hedge funds, and pretty much any other investment tied in any way to the US stock market. And here's a little secret for you. They're all tied to the US stock market. All of them in some way are correlated to the stock market, specifically the S&P 500. So if you look here, when you don't have any volatility like 04, 5, 6, 7, 8, you can go on for years thinking the world's great. And then an 08 comes along and you crash. And then you can go right back to growing at the same rate. And if you're a little more active and you can skip those big downturns and skip those big upturns, which one's going to work better? So the question becomes this: what's more important? Is it more important to risk, to miss the risky days and manage risk, or is it more important to pay attention to total return? Well, both. In order to get the higher return, though, you must mitigate risk. My partner, I'll talk more about him later, my business partner, Kelly, when he was at Deutsche Bank, the board of directors of Deutsche Bank handed him $4 billion of the bank's private money. The board of directors had to sign off on this. Here, Mr. Korshak, you get to manage this because your mathematics do what they do, and you're going to help us mitigate risk. And that was in the 80s. And so, again, I'm hitting risk like crazy because I want you guys to really understand whether you're in a real estate, a crypto, whether you're going down to invest in any type of foreign exchange or Forex and futures tradings, any of that stuff, you want to make sure you understand the risk you're taking. Understand the risk. Is there a risk of a total loss versus a risk of a partial loss? What does it all look like? Okay. Now, in our case, and I just like to show you guys what we do at Flip in comparison to that risk. I briefly showed you guys this slide yesterday. Over here, where you see the trade war and the COVID numbers, those are real numbers. That's real money. That's, in 2018, that was only about $5 million. In 2020, though, during COVID, that was almost $30 million we had on our platform at that time and what it was doing. So you could have lost 35%. Instead, you lost 9%. And when you look at that and you go backwards with it and you see these drops, yes, you drop. I haven't found the magic bullet that only goes up. You find that one, let me know, I'll buy it. But the trade war and COVID, they're real. If you look all the way back to 1987, and what has that AI done? It's avoided risk. AI and trading automation is absolutely what we market ourselves to do. We do let you trade by yourself if you want. If you want to be Robin Hood, you can jump on your phone. You can jump on this guy right here and trade away. That's not our unique value proposition. Our unique value proposition is our AI and automation. Now, this one I'm more excited about. I love sharing this next set of slides. Forbes magazine did a article. What was this about? The end of 2019. They did an article, and this is the second way the average Joe can help out, can benefit from our technology and our AI. This was a multi-university study published by Forbes, just so you guys know. Of the cost of a mutual fund, advisors, when you go buy a mutual fund, they're only required to disclose one set. They're only required to disclose one set. That's the disclosed costs. However, what they don't have to tell you, they legally don't have to tell you, and in many cases, they don't know. There's 3 other categories they don't tell you about. There are hidden costs. Now, they're going to be like, no, there's no hidden cost. There are hidden costs, and we're going to talk about them. There's costs due to tax inefficiencies. Mutual funds are extremely inefficient in tax. And there's just some downright sneaky behavior by big banks and big institutions that they do to make the paperwork look better than it actually is. So what we're going to do is we're going to break down each of these 4. I'm going to tell you a little bit about each of them. We're going to talk about what goes into each of them, how they impact you as an investor. Now, and again, I'm going to ask many more times, don't get off of this call or this webinar and run down to your advisor and be mean to him. This is what they do. This would be like getting mad at the Blockbuster guy for charging you a late fee when you brought back the video or you didn't rewind it. For those of you old enough to remember that, that's part of doing business. That's the way the fees are set up and they're structured. So let's talk about it. These are all the fees that are required to be disclosed. And I'm not going to break every single one of them down, but these are all required. They have to be disclosed, and they're on every document that every licensed advisor will put in front of you. And this is good to know. You need to know these things. These are what consist of the fee structure on the front of the window. Front-end loads, back-end loads, surrender charges, these all have to be put in there. Management fees, operation costs, administrative costs. Now, they're usually not broken down as to what you're actually paying for in the administrative costs, but there will be in some cases, it could be a surrender charge if you got to have a timeline in it. But these are all fees. Some funds have 1% to 5% front-end loads. They're huge when you talk about investing. So if you're not going to be there for a long period of time, you want to make sure that you know that. Anytime you invest, I would ask the person you're investing with to disclose per line item, what are the fees? What's the front end load? What's the back end load? Is there a surrender charge? What are my redemption costs? Are there any exchange fees involved? If there are, what are they? And just ask those. On average, across all mutual funds in North America, this costs you about 1.19%. These are disclosed, they're not hidden. You can find them if you go look, but it's about 1.19%. Again, this is generally the number that is on the door. We charge you 1%, 1.5%, under this balance or whatever. So those are the easy ones. And again, like I keep saying, there are more to the story. Hidden costs. What do you mean hidden costs, Randy? Well, mutual funds, they conduct trades. They all conduct trades. So whenever a mutual fund conducts a trade on behalf of another investor, of other folks, the fund will continue to accommodate other investors. So you're really going to end up with three. So when you start accommodating other investors, for example, as you invest into and divest out of, because you want it to be managed, right? You're in a mutual fund to manage that risk. You're spread out across a lot of stuff, but they're trading on behalf of other investors imposes a cost onto you. And these are the three costs that it associates. First, mutual funds have to pay the brokerage commissions on trades, on buys and sells. The broker is going to charge a commission whenever that trade happens. This is shared equally across, not equally pro rata of how much you own across the entire fund. All mutual fund investors must take on these fees. These are not disclosed. You don't see them anywhere. Secondly, mutual funds will often purchase securities from dealers at ask and sell securities at bid. Well, hang on, Randy, what do you mean? What does that mean? Well, ask prices are higher than bid prices. Ask is what you want to sell it for. Bid is what you want to buy it at. The funds often operate backwards of that. Why? Well, that bid-ask spread, that represents dealer profits, because mutual fund investors are all mingled up together, right? They're all commingled up together. These are the profits that go to dealers when these mutual funds trades. And in order to accommodate other investors, entering or exiting the fund imposes a cost onto the fund. This is also shared by investors. You don't know that. You don't know when the Quantra fund by Fidelity, biggest $1 trillion freaking fund, you don't know when it bought or sold the stock or when it bought more because it had more people join. You don't know that. However, those fees get spread out. And you're going to say, but the advisor would say, yeah, but those are pennies. Well, pennies on millions of dollars and percents on millions of dollars, it truly does add up. And third, when mutual funds trade, because their trades are often large, they can actually move the market. They can actually cause the total price of that stock to go up or down, right? This phenomenon has a name called price impact. That's what it's called, right? But because the price impact of the security, it tends to eventually return back to itself. This impact causes the mutual fund and you to lose money. It's a lot that goes into these hidden costs. There's a whole lot behind them. And so when you start really unpacking these hidden costs, like, wow, that's a pretty big deal. What does that one cost? Well, that's about 1.44% on average across mutual funds in North America. Now, remember, there were a dozen universities' finance departments participated in this study. This study went on for 3 years. They really dug in to do their homework as to what the real costs are of owning a mutual fund. What's it really going to cost me? Man, that's a lot, Randy. I didn't realize that. That's the idea. The next one's the one that bugs me the most. Tax inefficiencies. Tax inefficiencies. So, I'm going to walk you through. I'm going to slowly walk you through a sample illustration and what this looks like. Now, I just started with scratch to make up the numbers that we could start with. So let's just say you go down to your local advisor. You say, I've got $1,000, $10,000, $100,000. I would like you to invest this for me. And that advisor says, okay, great. He gives the money to the money manager, which we don't even really talk about in here. That money manager then turns around and buys a mutual fund. He says, great. You want to be in a big conservative mutual fund? We're going to buy it. We're going to put all your money in right now, today. There is no waiting. They don't say, okay, let's wait till the market's good for you to put it in. Let's put it in now. You give them the money tomorrow, the money's invested the next day. You give it to them today, it's invested tomorrow. So you go down, you're all happy, you're thinking you're doing the right thing, you're giving it to a professional person with a license that can manage your money. That person gives it to another person who then puts it into a mutual fund. Now, we all know that mutual funds are made up of large numbers of stocks, lots of stocks in these funds. That's the idea. That's their talk track to reduce risk. That's how they reduce risk. You get in the mutual fund, it's got hundreds of stocks in it, hundreds of stocks in it. So now you bought it today, or today's Sunday, you buy tomorrow. Now, this fund's going to, like I said, contain lots of stocks. There's going to be a lot of them. And let's just pick one stock in there for a minute. So that fund contains a stock. That stock is $50 a share. Great, it's 50 bucks out of my 100,000. I've got however many shares, doesn't matter. So now you're in that fund and the fund's managing it and it's watching it go along, and then all of a sudden that stock drops. That stock drops to $40 a share. It's like, oh, that's no good. My fund went down, Randy. I don't like that. Well, none of us like that. But now let's suppose because it dropped by $10, it dropped by 10 bucks. The fund manager says, oof, I think this stock's heading down. We're going to get out of it. There's too much going on. We buy this fund to manage risk. This thing's turning down. We got to get you out of it. See how that sounds quite sophisticated? So the fund decides to sell it. Dang it. I lost money on that one. I guess I could ask one simple question. Did that particular piece of the fund make you money, or did it lose you money? Well, you should have came up with a simple answer that you have now lost money. However, here's where it gets fun. So the fund has owned that stock a while. Matter of fact, the fund bought that stock for $30 before you came in. You bought it at 50 because you don't get to share in the gain right there. You bought it at 50 and it went straight down to 40. So you got a $10 loss. You got a $10 loss. So now what happens as the end of the year comes up, at the end of the year, the very end of the year, when you do your taxes, there's going to be a tax consequence on that stock that was sold. Whenever you sell a stock, if you gained money on it, you have to pay a tax. Let's say that again. This is real important for you guys to get. If I didn't play in the mutual fund, if I just went and bought the stock at 50, the stock went to 40 and I sold it, no tax consequence. I didn't make any money. If I bought it at 40 and it went to 50 and I sold it, there's a tax consequence on that gain. The $10 per share gain, I'm taxed on. Just like in real estate, you buy a house for $100,000, you fix it up, you sell it for $200,000, you have a tax consequence on the gain. Only the gain. Not an accountant. You can confirm that with your accountant if you like. So the fund bought it at 30. So did the fund make money? Yeah. So the fund has to pay tax on $10 a share gain across the fund. Across the fund, which means the tax on that $10 per share gain at the end of the year, you have to pay it too. Now, when you think about this, okay, I bought this stock for $50, sold it for 40, and now I'm paying the tax consequence on a $10 gain, not my loss. Well, that's the nature of the game. Maybe you bought it at 42, sold it at 40. Maybe you bought it at 38, you got a little gain. The point is that the tax inefficiency across the fund operates by itself. You just own a piece of the fund, not a piece of the individual stock. That's what you guys have to really resonate with this. For those of you that don't like taxes, and I'm one of them, this should bug you. This is going to cost you another 1.1%. It's another 1%. You're going to pay 1% in inefficiencies on average across mutual funds just because of tax inefficiencies. So why would you invest in that? Well, that's what we've been taught to do. That's how we've always done it. And so that's how the people of the financial services world protect you, the sheep. All right, one more. Costs associated with a mutual fund that are sneaky. And these are sneaky. You know, there are thousands of mutual funds out there. They're all competing for your hardworking money. You know, and that advisor, why would that advisor put you into that fund? So it shouldn't come to a surprise that there's a lot of sneaky behaviors that many funds engage in. They're not illegal. Just so you guys know, there's no laws being broken here. This is legal. This is the way the industry works. So first one I want to talk about is window dressing. Prior to reporting quarterly holdings, some mutual funds sell the poorly performing securities to hide that they even own these losers, because they only report what they owned at the end of the quarter. They don't have to report what they owned, you know, in February, only what they owned at the end of March, right? So the intent here is to hide the losers. They want to hide those. The funds then buy securities whose price has recently increased to make it look like they own these winners all along. This is normal behavior. Most funds do it. They're getting rid of the dogs, bringing on new ones. And then when the end of the quarter comes, they show the makeup of the fund. Here's the 100 stocks or 200 stocks or 50 stocks in this fund. And here's these 50 stocks average performance over the quarter. Oh, wait, the really crappy ones aren't in there anymore. No, they sold them. They got rid of them. So they're dressing up the window to make it look better. They don't give you the actual performance of the fund itself based on what was in the fund over the course of the quarter. They do not have to do that either. It's not required. Now, if you want to go jump into, you know, the Wall Street Journal and go read every day over the last 3 months and figure out what was bought and sold by that fund, you might be able to do that in some cases. In some cases, you might not. Another thing that they do, which I find very interesting. You know, I really find this one interesting, is that they'll, at the end of the quarter, they'll start shifting some risk and they'll start taking really big gambles to squeeze out a little more return. They're trying to get a little bit more. This is a big deal in the industry where they're trying really hard, these managers, especially as we're in volatile markets. I'm very anxious to see what happens at the end of the first quarter here as we're winding down March. We'll see what they're doing, what kind of gambles are going. You'll notice at the end of the quarter, you'll start seeing swings in funds, in not just in funds, but in stock prices, because when they, you know, dump a stock and they've got millions of dollars worth of it, it impacts the market. Remember from one of the other costs, the cost of moving the market up and down, that's what happens. The third behavior that I find fascinating is shirking. What is shirking? Well, this is where a mutual fund manager that has institutional clients, they actually care more about the funds and the performance of their institution. So if I'm managing Bank of America's money and I'm managing Randy Tate's money, who am I going to look to benefit the most inside the behavior of that fund? Am I going to steer this boat so that it does the best for Bank of America, or am I going to steer this boat so that it does the best for Randy Tate? So, you know, when you think about, you don't want to say care, because they still care about your money. I'm not saying that, but institutional clients, they may care more about the performance of that fund than other mutual fund managers who have just individual investors as clients. So the other side of that coin is, yeah, but Randy, I want to be in the fund that the big guys are in because they probably have better managers, possibly. So, you know, the mutual funds that are owned by big unions or by big banks, well, they might do better than funds that are primarily made up of individual investors as clients, as they're going to be a little bit less lazy. They don't have to be as lazy. When you got to answer to a board of directors of a bank, you got to be on your game. You got to be on your toes. You got to be prepared to answer these questions. That's what shirking is. And finally, another one, and this one's borderline unethical in my opinion, but again, it's not illegal. Mutual funds will often buy cold IPOs. So if you're a big fund manager and company X, Y, or Z went public earlier and they're not making the initial public offering sales that they need to, the guy over at Bank of America nudges the guy at the fund and says, hey man, help me out. I need you to buy some of this. I think it's going to be a good deal. It came out a little bit cold. Can you help me out and buy this? And when that happens, if it doesn't go well, Robinhood's a good example of this. You know, they went public, went up really fast. Now they're down way low. You really can't afford to sell them if you're a part of a fund. If they're in some kind of tech fund or thing, they're stuck. And so this is really mismanagement and sneaky behavior. You know, and again, remember, this is several academic studies published at finance universities. I know some of the universities that did this were University of Texas, University of Virginia, Georgia State, University of Missouri. There's a whole bunch of them in there, but across the country, right? And this one stings the most. This is mutual fund 101, 2.5% on average per fund in America. That's what this costs you, 2.5%. So if you're spending 2.5% on that one, it's like, wow, but Randy, the market's getting 6-8% a year. Well, what does that turn into the results? The real results in dollars, not percentages. You're funded an 8% return last year. Oh, great. I had 100 grand invested. I should have 8 grand. Well, we rarely have 100 grand so that the math is that easy. So, you know, there's a big total. Mutual funds can eat at the cost of the return. So if you invested that 100 grand, your returns might not actually be 1.8. Remember, you got a 1% in disclosed, 1.5% in hidden, another 1% in, you know, kind of that sneaky behavior. I mean, and 2.5% in that. So when you start looking it all down and you really break it out, you end up with $1,700 instead of $8,000. And I know many of you have tried to read your financial statements. They're very difficult. They're not easy. I'm not a big financial services guy. I don't even like reading them. I can't. And I run a fintech company. So the whole point here is this. Be smart with your money. Manage risk intelligently. Or worst case scenario, if this is good with you, you're like, yeah, you know, that's my father-in-law or my uncle. They've been managing my money forever. Hear this all the time. I don't want to rock the boat. That's fine. Just understand the cost of not rocking the boat. Understand what they're doing. Understand that they're doing the best they can with the tools they have. They're not getting rich off of you. Remember that disclosed cost at the beginning? That's all they're making. They're not making a fortune off of you, but a whole bunch of other people are. Lots of other industries are. And so when you think about the why we built this, why did we build iFlip? Well, to manage risk, to allow the little guy, the average Joe, to be able to participate in the market as effectively and as efficiently as a billionaire or an institution. I promise you, billionaires and institutions don't own mutual funds in the sense that you do. They might actually own the fund, but they don't actually buy into the fund. They profit off the fund because they're smart, they know what they're doing, and they're here to protect you, the sheep. So that is two big examples of why risk management is important. And I'm going to bring you back and I'm going to talk a little bit more about Kelly. I didn't give him enough kudos yesterday. You know, for those of you that might remember, I talked briefly about Kelly. He's the inventor, and I don't know if invention is the right word. He's the mathematician behind the AI. He created this AI out of years of algorithmic trading. He wrote algorithms. Paul Tudor Jones, Deutsche Bank, Brevin Howard, Solomon Brothers. You know, he was one of the quants among quants of Wall Street for many years. He spent a lot of time in that space, managing billions and billions and billions of dollars. He retired, met me, and became enthused about crypto as well, and started applying the mathematics to the crypto markets. And now, next week, we are releasing our crypto onto our platform. Like I told you yesterday, he's found a way to manage your cryptocurrencies and your equities and your ETFs and all of your stuff inside one portfolio without wallets, without exchanges, without keys. You can do it from one simple interface. He built everything in the back of it that does all of the actual trading. How is it returned? Everybody asks. Well, it returns really well, but it returns better comparison to the risk took. We actually didn't beat the S&P last year. We were behind it a little bit, but it was a pretty volatile year. There was a lot of risk. We're way ahead of it this calendar year. And if you take over time, since we started in 2017, just trading the S&P 500, he's 100% ahead of the S&P 500. And all of that in about 10 trades over that many years. It's not about day trading. You don't want to be in and out. There are no trade fees. That's not why you don't want to do it. You just want to manage the big drops. That's the idea. You know, Stanford University at the age of 16 in their physics program, pretty smart fella. So we are that solution. This is what we were built for. You know, we built this platform, iFlip, to manage people's money effectively and efficiency. It is the world's first artificial intelligence investing app that empowers anyone to succeed like a pro. We've now been on the market long enough. We've proven to be a superior performance and protection tool. There's that risk again, a performance and a protection tool. We allow people, we do it for them. The software does it to get in and out of the market only at the most favorable times. It's as if you had an entire team of Wall Street professionals managing it like they would manage a billionaire's money, not like they would put it into a mutual fund. That's the idea. No one else is doing this. We are first in this entire world. We are Netflix to their Blockbuster. We're doing it better. We're doing it easier to use, much, much easier to use. Our smart folios are a new coined phrase. And now the fact that we can mix crypto with equities, again, next step doesn't exist. We're 3 years ahead of anybody else if they wanted to go build this right now. I get asked this all the time, Randy, why doesn't Schwab or Fidelity have this? One, it's not profitable for them to have this and make it available to you. They don't make money, they lose money because they've got a lot of people they'd have to fire and wouldn't have jobs. And they wouldn't be able to charge you all those extra fees, all the extra stuff. They wouldn't exist anymore. The corporations don't want this. And if they did, at this point, it's freaking hard. There is some very complicated tech going on behind the scenes to put all of this together. Remember, our purpose, I told you guys this yesterday, our purpose is to empower every individual. And if we can't, then we're missing our mark. So now we are empowering every individual. We also, for those of you that are accredited, we also run a real estate fund because we do believe in real estate. I own 10 houses and own them outright. They rent, they generate cash. I take that cash, guess what I do with it? Put it into the software. We have a hedge fund, a crypto-only hedge fund being released in 2 weeks. Our crypto AI, crypto trading goes live this week. So we are broadening our horizons to make sure we're touching every corner of every person. And we do it mostly through AI. Real estate's not through AI, but we do everything else is based in AI, artificial intelligence, tons of data streams. And I am running short on time here. So like I said yesterday, text that word invest to that number, you'll get a scheduling link. Come get a private demo. If you're accredited, you can email me, randy@iflipinvest.com. Email me directly if you're interested in a real estate fund that pays fixed percentages and is also liquid. I'm a huge fan of liquidity. Liquidity means I can get my money without a fee. That's liquidity. Most places you can eventually wrangle your money out of people once you've given it to them, but they're going to charge you a fee. Real estate, there's no liquidity until you can sell the property. So I want to encourage you, all of you, to get to know us. Our website, iflipinvest.com. Whether you've got $200 to invest or 2 million, we have a path for you. Our purpose is to empower everyone. And so, Jason, I'm going to kick it back to you. It's 7 minutes to 8. I might have talked a little over today. I talked a little under yesterday. I just wanted to share some knowledge with everybody today, and I hope that everybody found that acceptable.